Good afternoon, everybody, and welcome to today's webinar titled Avalanche and the Internet of Finance. We are very fortunate today to have two real preeminent leaders in the blockchain and crypto asset world, and frankly in the broader world of finance and technology. Emin Gun-Sir and John Wu of Ava Labs. As many of you know, this is our most recent webinar in a series which we began after the coronavirus began to really strike in earnest. Our firm, the Blockchain Research Institute, has transitioned and has been for over a year to a digital model where we are delivering services to our members and to the broader community online. So it's very fitting that we launched this webinar series. So far, we've had thousands of people attending, calling in from all over the world, and we've had some really great conversations on a number of different topics, ranging from how supply chains will be built in a more resilient manner in the future, to the future of money itself, the future of central bank digital currencies, and where the United States, China, and others fit in that. Today's topic is also quite intriguing, and one that I think is going to have a big impact on the future of the world, and that's the future of financial services and what kinds of technology tools we are going to use to build it. So I'll start by saying we hope you're all well at home, staying safe, socially distanced, that you and your families are healthy, and that you're thriving in these very difficult times. If you'd like to learn more about the Blockchain Research Institute, we are going to share a few links in the chat, which everyone should be able to access, for the Blockchain Research Institute website, as well as some information about our upcoming flagship event, Blockchain Revolution Global. Last year, our event was hosted in Toronto with about 1,100 people from 50 different countries. This year, it'll be an all-online experience. We're partnering with some firms we've worked in the past, including Art Media, to make this a very rich and engaging virtual experience. I'll also encourage you to check out our new books, Financial Services Revolution and Supply Chain Revolution. Financial Services Revolution is the one that deals head-on with some of these very interesting topics, which we're going to dig in today. So if you're looking for further reading, I would strongly encourage you to check that out. And then finally, as many of you know, we have an online education offering in partnership with INSEAD, the #1 business school in Europe, and Coursera, called Blockchain for Business and Blockchain and Financial Services. Those two courses together have over 25,000 active learners and have been very popular and very well received. So I would encourage you to check that out. So on to today's webinar. Public blockchains, such as Ethereum, have demonstrated the potential for blockchain and crypto assets to reimagine and reinvent many aspects of money, markets, financial services, and business. Bitcoin was the first blockchain to launch, and what Bitcoin did was quite revolutionary. It showed that we could use a native digital medium to move value between two parties without the need for a trusted intermediary. And in that case, the medium for that value was this thing called Bitcoin. But what this technology has demonstrated is we can actually program it to adapt to many different kinds of assets, many different kinds of marketplaces, and many different kinds of business use cases. However, these first generation networks, such as Ethereum, in part due to their own popularity, first through the token issuance cycle and more recently through the popularity of decentralized finance, or DeFi, have been congested. And as a result, many enterprises who are most of our members, and many of you joining today, work for big companies, are openly wondering whether or not they can meet the demands of vast global businesses and marketplaces. So while Ethereum works through its long-delayed upgrade to Ethereum 2.0, which ultimately may prove to be successful, a new crop of open-source blockchain platforms is promising solutions for enterprise blockchain deployments in one interoperable, highly scalable, and importantly, easy-to-use ecosystem. Avalanche, one of the leaders of this group, says that its technology allows businesses to build powerful, reliable, and secure applications and custom blockchain networks. We are very fortunate, as I mentioned earlier, to be joined by the founder and the president of this organization. So Emin Gün Sirer is the co-founder and the CEO at Avalabs. He is a professor of computer science at Cornell University, where his research focuses on operating systems, networking, and distributed systems. He is well known for having implemented the first currency that uses proof of work to mint coins, as well as for selfish mining, characterizing the scale and centralization of existing cryptocurrencies, and having proposed the leading protocols for on-chain and off-chain scaling. He is the co-director of the Initiative for Cryptocurrencies and Smart Contracts, IC3, which aims to move blockchain-based applications from whiteboards and proofs of concept to tomorrow's fast and reliable financial systems. Our other guest is John Wu, president of Avalabs, the company creating the next generation blockchain platform. John joined Ava as part of its acquisition of Investory, a SaaS platform he founded to facilitate investor discovery, management, and transacting of private market assets. But before Investory, he was CEO of Shares Post Digital Asset Group, working with investors and issuers to enable compliant token trading at global scale. Prior to that, he was a technology investor and the founder of SureView Capital, which was backed by Blackstone Group. And he began his investment career at Tiger Management, a preeminent hedge fund with $20 billion in assets under management at its peak, before managing a global technology portfolio at Kingdon Capital. John received his MBA from Harvard University and holds a BS in economics from Cornell. And in a sort of funny bit of history, John and I knew each other many years ago, both when we worked in the traditional financial services world, and more recently began to collaborate in a few different ways. And it's been really interesting and quite rewarding for me to see my friend John and his journey to where he is today, this very exciting project. So let me start first by just saying thank you to John and Gun for joining us today. Thank you very much.
Thank you.
Thank you for having us.
So Avalabs has a sort of an interesting history, as many of the best projects in this space do. And Gun, I was hoping that you could maybe walk us through the events that led to the creation of Avalabs and the Avalanche protocol, maybe starting with your days or your current job or your previous job, I guess, at Cornell University. Can you tell us a bit about that?
Sure. So this all started out many years ago, I would say maybe 4 years ago, when we got this idea of a very lightweight consensus protocol based on essentially nodes not necessarily asking everybody else how to finalize which transaction and so forth, but instead to follow a different strategy, one that is far more lightweight, one that is far more scalable. And so we had made a bunch of headway into this process of exploring this new space, this new set of this new family of protocols. We had a number of simulations, but it had been proving difficult for us to get to the final level where we can actually prove it to be correct. And we were contacted by a group that's choosing to remain anonymous so far, or has chosen to remain anonymous so far. They call themselves Team Rocket, and they said they had been working on a set of protocols that are very similar to ours, and they gave us the core correctness proof.
Hey, good. Sorry, before you go on, we're just getting some feedback from people that the volume is a bit low. I don't know if you can speak into the mic or speak a bit louder.
Okay. I've never been called out for being too too quiet.
Me neither.
That's not me. Okay, let's try this again. So we've been working on a set of protocols, a family of protocols ourselves at Cornell University with my team. And these protocols were very, very promising in simulation, but we didn't have a correctness proof. And we were given a manuscript, an early draft that contained a correctness proof for a very similar set of protocols. And we worked with this anonymous group to massage the work jointly, if you will, to come up with a clear, crisp definition for the protocols themselves, and to come up with a corresponding correctness proof. We also help them with related work and past work in this space. This protocol and this family of protocols is nothing short of a breakthrough in my area of expertise. That area is known as distributed systems. The problem of consensus has been known in this area for at least 45 years. And there had been many hundreds of protocols already explored, and we call them classical protocols. And those protocols they all had the same problems because they all require everybody who's participating in the protocol to have heard from everybody else. They don't scale. They do not go and allow large numbers of people to participate. It was partly in reaction to that the second big breakthrough came from Satoshi. Satoshi's consensus protocol about 10 and a half years ago was the second biggest breakthrough in that space. And in my view, the Avalanche protocol is the third biggest breakthrough.
Okay, so to make it real for people who are listening in, you talked about the problems with the consensus systems not being able to scale, and how everybody who was connected to the network sort of needed to reach agreement in order for new blocks to be added, and in other words, sort of a new state to be updated in the system. Why is it important that we figure out ways to do things much faster? And how are we able to do that without trading on the things that make blockchains so useful, which is things like their immutability, their security, and the way in which everyone can trust what is on them effectively?
So great question. And I think one of the main obstacles standing between the vision that we all share, the blockchain vision, the vision that you outlined so well in your book, the one that motivates so many people to try out blockchains, and reality, making them mainstream, is this big obstacle known as scalability. Blockchains today are very slow. If you try to onboard large numbers of people, well, their performance is limited. So, the proof of work chains that we look at, say Bitcoin, Ethereum, and so forth, they have difficulty going beyond a few dozen transactions per second. And a few dozen transactions per second, they are, that's a great start. It's great for demonstrating the capacity, the potential of these technologies, but they're not enough to support more than, let's say, IKEA on a busy Saturday. Right? IKEA on a busy Saturday easily does more than a few dozen transactions per second. So we need ways to scale these chains up to accommodate the world. We also need larger numbers of participants in order not to do the fundamental trade-off in these systems, which is a trade-off between centralization and performance. Do we not all know how to get really great performance? Of course we do. If I run my chain out of this very laptop that's in front of me, I can do hundreds of thousands of transactions per second, maybe millions out of this little very laptop. But that would give up on one of the most crucial aspects of what blockchains bring to the world, which is decentralization. So what the Avalanche protocol does is it opens up the world in both dimensions. It opens up the scalability side, and we have shown that with Avalanche, for example, that we can exceed Visa speeds in a decentralized setting. Let me say that again. A few years ago, I had a chat with Bitcoin developers, and they said, look, it's this technology, it fundamentally cannot scale to Visa. We could maybe double our speed, we could maybe change the block size, we could go to quadruple, but we can't go and exceed and compete with Visas of the world. We have to take a different tack. And they're right. The proof of work side of things really cannot go to these high speeds without giving up on decentralization. But we should.
Okay, so
Go ahead.
Yeah, no. Well, I wanted to turn it to John, because you mentioned an example from the traditional world of financial services, which is payments. And John, you spent the first and maybe even second chapter of your very illustrious career working in the traditional financial services world. And I wonder, looking at this technology, I think about my days on the desk and all the different intermediaries that were required to clear and settle a transaction and say, a stock, right? You've got broker dealers, you've got clearing houses, you've got an exchange, you've got custodians of assets, there's a regulator in the mix. And even though the front end of the financial industry moves very quickly, high frequency traders measure competitive advantage in nanoseconds, the back end is very slow and costly. So to me at least, there are many obvious examples where this technology would be very effective in disintermediating many of those parties and allowing buyers and sellers to do business peer-to-peer in a marketplace. And I think there are obviously lots of benefits to that. But the problem that Gun is defining here, which is that the technology itself doesn't scale, or hasn't historically at least, because of some of these limitations, would appear to put a real sort of internal speed limit on these financial markets. So at what point did you realize that some of these challenges that have been described here so well could be overcome? And for you, at least, what are some of the most interesting examples in financial services where Avalanche can be applied today?
Sure. Well, like you, as a practitioner in the financial services space, we had firsthand knowledge and we were users of old legacy technology. A lot of the financial services firms, whether it's banks or even hedge funds or private equity firms, they rely on their own little tech stack. Today it's in the cloud on Amazon, but back then it was in a server room back in the basement somewhere. And they frankly just relied on a giant back office of people, administrators, accountants, and all of these different people that basically created a very cumbersome workflow. And like you said, on the front end, especially with high frequency trading, it seemed like things would settle very quickly. But on the back end, it was absolutely not the case. Debt financing, sometimes if you do a syndicated loan, it'll take 16 to 25 days in order for things to settle. Equities now, we've moved from 3 days to 2 days to settle. And in private securities like Airbnb, we're talking about 30 to 90 days to settle. Part of the reason for this is because of the different silos, databases, and human aspect of the workflow. But the other part of it is frankly just getting everyone on to call it a centralized database without a centralized party, a distributed ledger that everyone can get access to. And if you can instantly settle equity trades or debt transactions and even private securities, you are basically taking a lot of money that's stuck in the system. We're talking about trillions of dollars and freeing it up for better investing and better workflow. We're talking to a few banks right now. I'll give you an example. In a typical debt financing situation, you've got, call it Bank A and then Bank B. If Bank A loans to Bank B, and then Bank A syndicates that loan to 5 or 6 more investors, suddenly you've got Bank A actually becomes administrator of the cash flows and the workflow and the paperwork. And all of a sudden you've got 8 different or 9 different servers, databases all over the place, repeating the recording and validating of each transaction. If you can put it all into one centralized data, but this in a distributed ledger, without that centralized body, a trustless manner, suddenly you can create a very efficient and embed all the rules into a protocol, including the distribution of dividends, or if there is something that changes like an early payment of the loan, suddenly things can be instantly transacted, and all participants, especially the investors, will appreciate having a higher IRR because they can take their money back and invest it in something else.
So in that kind of an example, let's go back to doing it because I want to understand how we marry the technology with the business use case, right? So in the example that John provided, let's say you've got a handful of banks and a few investors who are all really not interested in blockchain. They're interested in syndicating this bond or becoming owners of it as an investment. How easy is it today to let's say pre-AVA, to build a distributed system that allows for all of these different parties to have a trusted record of who owns what and what cash flows are owed to whom and what amounts have been paid to date? Is that something that's even really feasible today? And but depending on how you answer that question, just tell us in practice and in simple terms how AVA could address something like that.
Sure. I think before Avalanche came along, there were really 2 options. One of them is known as public blockchains. So you could go to Ethereum, you could go to Bitcoin maybe, you could go to one of the existing chains and build something on top that allows people to create these instruments, these custom instruments. You'd have to write some code for it. You'd have to build the infrastructure to trade it, for it to exchange hands. And you could create a public instrument, doing so in a manner that's compliant, of course, would be very, very difficult. The alternative is private blockchains. And just about everybody I have spoken to in the top 100 companies has already dipped their toe in that water. They've already done a proof of concept. They already understand the scene, and they have all decided not to deploy private blockchains in mission critical settings. The reason for this is actually fairly simple. There's nothing inherently wrong with the idea, but there are many, many, many difficult operational issues with them. And the main one is that it's very hard to create a consortium, a private consortium, and to keep it together, and then to bridge these consortia as they come up. Which ones do you belong to? Why? Which ones do you bridge together, and how, and so forth? And in between these two extremes lied a giant chasm. There really was just two options. Do you do private? Do you do public? In fact, even if you go to Wikipedia today, you'll find that it's just, it's presented as if you have a dichotomy. You pick one or the other, and there's nothing in the middle. So Avalanche addresses this. Avalanche allows people to create what we call sub-networks. So there is the giant Avalanche network, but you yourself don't have to use it. What you can do, in John's example, is you could create your own dedicated subnet for your own individual instrument. And that subnet would be taxed with implementing whatever rules pertain to your new asset. So you could build a new, what we call a virtual machine, that determines how that asset behaves. You could also, and this is crucial for us, and this is crucial for many issuers, you can also control who gets to be part of that network. You can say, look, this is going to be a Canadian regulated network subject to Canadian rules, and all of the network participants have to be in Canada. Or you can say this is a North American subnetwork. You can say this is a subnetwork that is governed by the GDPR. Or you can say this is a subnetwork where all the participants have signed the following agreement. Or you can say this is a subnetwork where all of the participants have the following resources in terms of machine resources, RAM and disk and so forth. So you can build a striated network. You can build a rich network consisting of many subnetworks. This is kind of similar to how the internet started. The internet didn't get started by all of us connecting together. It got started by every university creating its own subnetwork with its own rules and then bridging those together. And the job of the Avalanche network is to facilitate this creation. It's really trivial for anybody without any programming whatsoever to create a new asset, to create a new subnetwork that governs the behavior of that asset, and then to bridge those subnetworks together.
So would you say that the goal of Avalanche, if you were to sort of pie in the sky, is to be basically like the TCP IP of the world of blockchain networks, essentially?
Absolutely, of asset creation, the TCP IP of digital assets.
Now, when you say those different sub-networks, though, do each of those sub-networks need to be created on the Avalanche technology stack, or can Avalanche help to connect disparate networks that aren't Avalanche? Say, Ethereum is well established. I don't think it's going anywhere. Is Avalanche complementary to that, or does it need to overcome those other protocols?
So the Avalanche network can bridge. We have explicit bridges to existing networks that we are building right now. So we will be able to support and convert Ethereum assets to Avalanche assets as well. But when I say that Avalanche is the TCP IP of digital asset creation, what I'm referring to is the protocol itself, enabling people to create their own subnets and bridging those subnetworks together with each other. In doing so, it's essential to underscore one factoid, which is you do not need to use Avalanche to actually create your own token. We are not pushing our token, we're not pushing the Avalanche, the AVAX, the coin, into private use cases. So if you want to create, in this example with credit default obligations, I think it was, you want to create something that corresponds to a CDO, you can do that. You don't have to touch AVAX at all. You don't have to touch any other coin at all. You just build your own private network. Now, when it's time to bridge, you can bridge with your best friend. Again, never having to convert your asset to AVAX. It's only when you want to open it up to the public, that's when you have to, the only thing you have to do then is hold and validate Avalanche so that there's a connection between the Avalanche network and your network.
Right. So that goes to my next question. Just on last.
Well, to highlight that point, Alex, we are working with call it a large European asset management firm. and they are creating a real estate fund, and they want to launch that real estate fund potentially on the Avalanche protocol. And the feature that they love is what Gun just said. It's the sub network. So they have many, many funds, and maybe each one of these funds can be separate sub networks. And the reason for separate sub networks is I'll get to in a second. But the goal right now for this asset management firm to launch call it a fund on the Avalanche network in a private manner is so that they can, one, control the life cycle of that fund. And they're not looking like in 2017 for necessarily increased distribution. And they already have their own LPs. They don't need new LPs. But what they give is they save somewhere between 100 and 200 basis points in the workflow. Suddenly, you have auditors, the accountants, you have the KYC AML, you have all the other players involved, custodians, banks, and all of a sudden, that workflow is streamlined. They save money. Secondly, those LPs suddenly don't have necessarily a liquid market that they can trade their LP units, but after a year, when the units are more free-flowing, they can sometimes top up or top down. And during COVID, we realized certain players wanted different assets after realizing that real estate in the 7-10-year fund was not really what they wanted. So then suddenly they can connect to their other LPs if they want to open up sub-networks to call it their tech fund or something. And all of a sudden, those two investors, traditionally with different type of investment horizon and return dynamics, because of COVID, suddenly want to talk to each other and maybe swap assets, and creating sub-networks for their different funds allows them to connect easily.
Yeah, so let me, that's a great point, John. And I'll rephrase a couple of those things for the group who's listening in, just in case they don't have the same financial sort of background. So the reference to 2017 was to the period where there were a lot of new token issuances. And the distribution question is one where by issuing a token, you can tap into all these marketplaces of investors, both big and small, that maybe you weren't able to do before. And that is obviously an advantage of issuing a token. In the case that John was referring to, that wasn't a priority here because this firm has already well established and had investors. What they saw as the benefit was the ability to reduce costs by about 1% to 2% and to automate all the workflows. And the ability to sort of customize the fund after the fact to make it more fungible, basically, and more adjustable, which is really not well understood. And John, you and I both know from our previous lives, running funds that it's private markets can be incredibly arcane and complex and analog in how they're organized, and really it comes down sometimes to spreadsheet and email list to change these kinds of things. So that's obviously a very, very big benefit. The idea of a sub-network, would it be fair to say, to recharacterize this, a sub-network as basically a sub-market? The idea that, you're creating a sub-network which allows you to adjust the terms of the asset, in this case, that's on the Avalanche protocol, so that it can be traded and moved and stored and managed and owned differently, right? So it's like a new way to structure a market for that asset. Is that accurate way to think about it?
Absolutely. I think a subnetwork is essentially a market with its corresponding rules for assets and corresponding rules for resolution and settlement.
Okay. So this has been a great discussion. I'm just going to remind everyone who's listening in that we will be answering your questions towards the end. I have a few more things I really want to get through here first, but please feel free to ask your questions in the chat or in the Q&A box, and we'll try to get to them as best as we can. So a couple things for you guys. It all sounds great, but is Avalanche launched yet? Can someone go do this today, or do they have to wait? What is the timeline right now to actually, hit the ground running with this technology?
Great question. So we got funded and got started on the commercialization path just about a year and a little bit ago. And I'm proud to say that as of last week, we issued the Everest testnet. So that is a mainnet candidate, and we expect to see our mainnet coming out in the next few weeks. So we're within inches of being live and up. So I'm very excited about that. The technology is here. The technology is ready, and the main thing that we're waiting for to go mainnet is integration with third parties, with external parties.
And just to note the success of Everest, we already have in a very short period of time over 500 validators.
In an unincentivized test network. These are just people who just wanted to be part of this big revolution. It is the first new protocol in 10 years, new protocol family in 10 years, third big thing to happen in 45 years of research.
That's amazing. I noticed also that you're backed by some pretty well-known venture capital firms like Andreessen Horowitz, which I think is notable given that Marc Andreessen was the inventor of the web browser, which was a way to access the original network of networks in a relatively simple and easy way, right, for average people. You didn't have to be on the ARPANET at Cornell or wherever to access it. You could be an average person. So do you think that Andreessen sees, and to be clear, like Avalanche is not the only thing that Andreessen is invested in. They're obviously spreading their bets to a few of these different kinds of protocols. But do you think part of the reason that they're interested in these networks, and you guys maybe in particular, is because they're looking at this as the second era of the internet, and they're looking to find the technology solutions that allow this to become mainstream and to become easily accessible? Has that been part of the thinking? And then just another question that's sort of related, which is that we talked about the token itself. I'd like to. You mentioned that you need to own it in order to sort of prove who you are on the network. If you could just go into a bit more about the utility of the token as well. Those two questions I think would be really helpful for people listening in.
And maybe I'll help answer the first part, because I know Gun is very humble and shy. I think part of the reason that Andreessen Horowitz or A16Z saw a lot of interest in Ava Labs and the Avalanche protocol, frankly, is because they looked at the team. And Gun is one of the preeminent distributed systems and network professors in the country. And he had a whole team of his students, PhD students and undergrad students. I think we sport over 8 PhD candidates or PhDs in our firm. So one very important reason why Andreessen Horowitz looked at us is just a world-class computer scientist team. And couple that on the business side, the business development team has over 50 years of real pragmatic Wall Street type experience at the top firms on the landscape. Mm. Secondly, I think Andreessen Horowitz looks at blockchain, and Marc Andreessen's well known for saying software is going to eat the world. As you noted, he founded Netscape. I think they love, and as a tech investor, and you were also in financial services, we've been all taught to love companies that have low capex, high margins, and basically potential network effects to really increase the supercharge those margins. In other words, scalability and blitzscaling a business. If you look at the blockchain business model, especially on the permissionless side, there is no other business model that would blitzscale as fast as a blockchain business. In one workflow, you get to raise capital in order to create utility, as well as effectively market, and also incentivize developers to all join in your community, and also have users participate all in one workflow. There's no other business model out there that is that good at scaling and blitzscaling when done correctly. So I think A16 in general loves first layer protocols or players like ourselves because of that concept, the fact that they love scalable businesses.
Mm-hmm. And Gun, then the comment just on the token itself. This is something that people, I think not everyone who's deep in this space fully understands why in a proof of work system, the idea that there's a mining component, you earn this token, and the energy that goes in is one of the main reasons the token holds its value. I think is, after a little bit of thinking, does make some intuitive sense. So, but within your system, it's different than that. So just talk about briefly the token. I don't know, the token economics. Why the token is important to the functioning of the system.
Sure. So the AVAX token that powers the public Avalanche network is very similar to Bitcoin in many ways. It is a hard-capped asset. So there will only be at most 720 million AVAX coins. And they're minted according to a schedule. Now, unlike many first-generation coins, the minting schedule in Avalanche and AVAX is subject to governance. It can be changed. We can mint a little faster if the conditions require it. We can mint a little slower if the conditions require that. And the people who determine whether we go faster or slower are the coin holders themselves. There is absolutely no central bank. The hard cap, however, even if you go fast or slow, what you're doing is you're approaching the hard cap according to a slightly different curve, but you are not going to be able to change the hard cap itself. So it's a scarce instrument, kind of like gold in that sense. The minting is done by a process called staking. So people who own the tokens can participate in the token economy, and they can use the tokens in multiple different ways, which I'm going to explain in a second. And for their participation, they get rewards from the system. Their participation in securing the network, they get rewards from the system. Whereas, as you point out, in the proof of work system, what protects the network is the energy required for the mining rigs. In a proof of stake system like Avalanche, what protects the network is the value that is trapped in the stake. So if you wanted to do something to the network, like you wanted to participate in creating blocks, or maybe you want to disrupt the network, you want to send bad messages around. Well, to do that, you need to pony up some AVAX coins. You need to tie them down for some period of time, and that economic cost, just like the energy expended for mining, is the cost that is required to protect the network itself. The coins are useful in multiple different ways. They're used for transaction fees, that's one. They are used to secure the network for staking, that's two. Number three, they are used as the fuel to create other assets on top. So this whole process of creating new assets, new digital assets, creating new sub-networks, all requires some number of AVAX coins to be expended. And finally, maybe I should mention this. This is a very communal protocol. So in other protocols, there are typically there's a designated class of people known as miners. So Avalanche doesn't have those. Everybody is essentially in the same boat. In other systems, there usually is some notion of collecting rewards and giving them to the miner who did something or another. In Avalanche, there is no such thing. The AVAX that are required to create a new asset, or the AVAX that are required to issue a transaction, these are burned. And so that burn benefits everybody equally. And so it's one of the many ways in which this is really a coin for the people, governed by the people.
That's a great explanation. On your website, it says Avalanche is an open source platform for launching highly decentralized applications, new financial primitives, and new interoperable blockchains. The subject of this webinar is the Internet of Finance, and financial services is the thing that we're talking about a lot here. I think there are probably other use cases that we could talk about beyond financial services, but today, at least, the topic du jour is decentralized finance, or DeFi for short. And DeFi has drawn no shortage of praise and also criticism. For me, there's definitely an element of tread lightly when it comes to some of these emerging applications and products. But at the same time, I find it really exciting because most sort of fintech innovation, if you want to call it that, is really innovation on the margins. It's user interface, building things that make accessing marketplaces like, say, stocks and bonds, like Robinhood, a bit easier, but it's not tackling the deep architecture and the deep infrastructure of how financial markets actually work. DeFi is doing that in its own sort of special way. It's creating, lending markets, for example, that don't have banks, and that's something that's quite novel, and I think people underappreciate how important that is. So how do you think about capturing some of the excitement and drawing in some of these users and application developers to Avalanche in the DeFi space without compromising, I guess, the brand if and inevitably when some of these things go wrong, because many startups fail and not all projects, ultimately are successful, right? So figuring that out, especially at this early stage of your growth cycle, I'm sure is something that's very top of mind. I was wondering if you could maybe talk about that. John, do you want to take the first crack at this one?
Sure. So there's a lot in that you just, in that I think it's more than 1 or 2 questions in there, but let me try to address a few of those. First, the DeFi developers and community are already migrating towards Avalanche in the test nets. They find it very intriguing because they are right now in the Ethereum world, there's obviously high gas prices and congestion. They want to see if there are other avenues that they can basically create what they're trying to do in a less friction type environment. So it's already happening. And I think the second thing you're alluding to is regulation. And what we saw in 2017 with ICOs coming from traditional finance, yourself and myself, we all recognize those ICOs in the US really were basically end arounds from the Securities Act of 1933 and 34 and not relying on Reg D and Reg S and 144 exemptions in order to move those assets around or raise money associated with it. So DeFi right now is just getting really, really big. And I think what you're saying is, how do you avoid players in the DeFi space that perhaps will get regulated or there will be some backlash again so that we at Ava Labs don't get in trouble? Is that the question, basically?
Well, you can answer it that way. I'm actually a little less concerned about that. If you think about the internet as an example, if you're an IP service provider, or you're a platform, the regulations evolved or were clarified to say that you weren't necessarily liable if people were supplying drugs or something on the internet, right? Because you're just a platform. And I hope that you take the same approach when thinking about Ethereum or Avalanche or any of these other ones. It's more just I suppose you could.
So by the way, you answered. You gave the answer I was about to give.
Yeah, maybe.
We are the platform. Obviously, if we know that they're doing something that's completely egregious, we'll do our best to not participate. But the way we see it is, we're not the operator. We're the technology provider in the platform. Yeah. And we, again, if we see anything that's really egregious, we will do everything possible not to participate.
Okay. I want to move on to some of the questions that have been asked in the Q&A, because there are some really good ones. Stephen Bauer asks, interconnecting blockchains is at the center of many other efforts, Cosmos, Polkadot, Ethereum 2.0. How does Avalanche compare and contrast to those? It's very topical. I mean, Cosmos and Polkadot are now top 20 tokens. And I think people are realizing that, with the second wave of interest, this renewed interest in blockchain, there's more scrutiny being paid to which projects actually have real technology, have actual communities, and are seeing application development. And I think Cosmos has been around for a year and a half. It's very clear to me, at least, that is one of the leading protocols. Polkadot just released, maybe perhaps less proven, but people seem to be giving it the benefit of the doubt. And then, of course, you've got Avalanche, which I think fits neatly into this new category of very promising technologies. So how do you differentiate yourself? What is the difference? And then also, is it even important that you, well, not that you are different, but rather, is it something where these things can all coexist and scale together, or do you really see this as a winner-take-all kind of marketplace?
So I certainly don't believe in winner-take-all in this space. There are many such people who claim that there will be only a single emerging network. I don't think that's going to be true. There are so many different uses for blockchains. There will be a lot of different networks that win niche markets, and they will perhaps in a very, very long time scale merge together, but certainly it's not a winner-take-all game. We love Cosmos, we love Polkadot, we love everybody who comes into the space with sound technology and scientifically backed claims. So let's just start with that. We have fundamental differences between both of those protocols and Avalanche. Mm-hmm. Both of those protocols are squarely in the classical protocol category. This is a category of protocols that we all knew about in 2009, that Satoshi knew about in 2009. And he said, I am not going to pick this as the basis for my new currency because these protocols are fragile. He had to invent his own mining-based currency because he needed something that was more robust and more open. Those protocols only accommodate a very small number of participants. So on each chain, in the selection of any given block, they typically involve about 100 people. Whereas Avalanche can involve millions of participants. We do not have, crucially, we do not have this winnowing down step. We don't have representatives. We don't have designated block producers. They go by different names. We don't have designated validators. These things tend to turn into cabals, these chosen folks who sort of are socially well connected. We saw in the EOS world all kinds of things that they do behind the scenes, extraneous to the network, to ensure that only their best friends stay in that circle that is rewarded. In contrast, Avalanche is really an open protocol. It's far more robust in its operation. It can tolerate far more inconsistencies in the views of the network of the participants. It can achieve higher performance than these. And overall, I think there's a big difference in the visions behind these protocols. So Cosmos, as I said, is following a fairly straightforward approach, building on the PBFT legacy. PBFT is a classical protocol. Polkadot is building on the Ethereum legacy on the world computer front. We are doing something completely different on the business side. I'll let John explain this in more detail. But what we're doing is really unprecedented and quite different compared to everybody else that I know of. So we're not trying to compete with the dollar. We're not out there to take down the euro. That is not our value proposition. We wish luck to people who want to do that. That's fantastic if we could do it. But that's not where we are going with this. We want to digitize all these assets that are currently not in digital form, that are currently not in blockchain form, that currently have limited reach. And so that is a big fundamental driver for what we want to do. And that's one of the main things where we differ on the vision side. And there are a whole bunch of technical differences that I'm not going to bore your audience with in the Cosmos zones versus Avalanche subnets and so forth. One of the second most fundamental things where we differ is we do not need Avalanche, the AVAX, the token, to be used as a facilitator between independent parties that don't want to interface with the public network. So that's a big point of difference. We are not trying to bridge disparate technologies. We're trying to bridge solely the Avalanche-based subnetworks. And so those all put us on a different trajectory from everybody else. Our interoperability, anybody can be an interoperability provider. All you have to do is run two nodes at the same time and connect them somehow. The Avalanche approach to this is quite different from Cosmos and Polkadot.
That's great. And I think that leads nicely into this next question. And maybe, John, you can answer this because it's more on the business side of things. So for enterprise leaders who have Bitcoin or Ethereum-based blockchain pilots or solutions for digital assets that are already in production, how should they be thinking about Avalanche? Must they rebuild on Avalanche, or can they easily integrate? There are some other protocols which have solutions like, Cosmos has Ethermint, for example, the idea that you can sort of take these assets and move them over. How does Avalanche think about that? Because, with Ethereum in the early days, it was, if you wanted something other than Bitcoin, it was the only game in town. And there are, quite a few projects, various stages, some almost at production level using Ethereum. I think it's probably one of your objectives to capture some of this market share of companies that have already demonstrated an interest in using blockchain. So how do you think about that, and how does that work in a technical way that you can explain to a non-technical audience?
So we've actually come up on some bake-offs in terms of proof of concept work against both private blockchains and public blockchains. So doing proof of concepts, competing against Hyperledger or Corda. And I think all the examples that I've seen and the feedback I've gotten from enterprises who are working with us is they love the fact that over there, it's about 100 nodes. Over here, we can do basically unlimited validators. The other thing that's been super important and stressed over and over is basically our ease of use. Our WASM allows programming in multiple languages. I think a lot of enterprises, although people are coming into blockchain, they don't have necessarily the blockchain dev talent inside. So if you're working with Ethereum, you're kind of relegated to Solidity developers. But with Avalanche, our WASM allows you to program multiple languages. It makes it a lot easier for their own internal people to create assets and to create subnets. So that's some of the feedback I've gotten. And in terms of how interoperable we are very interoperable, as Gun has already said. In fact, even Hyperledger and Corda, they can sit underneath Avalanche, and we can work with them in that way.
So let me add one thing to that, what John said, because the question explicitly mentioned people who are building Ethereum-based solutions. So if you have some Ethereum-based solution today, you can deploy it on Avalanche, on what we call the Cchain, on the contract chain, and it is byte by byte compatible with Ethereum. You have to make 0 changes. It will take you somewhere between 2 to 3 minutes to be able to do this, and the vast majority of those minutes are going to be spent Googling Avalanche Cchain, how to use, and then clicking on the link, and then figuring out that you have to make one entry in MetaMask or Remix, and you deploy. Not, normally you deploy on Ethereum mainnet or you deploy on Ethereum subnet. You could just add an entry there that says Avalanche Cchain, and then you deploy on Avalanche Cchain immediately and directly, the exact same code with the exact same semantics. No security audit necessary, no changes. It runs exactly as it would on Ethereum, just much faster. And with lower fees, I should add.
Right. Very helpful answer. Just looking at the time, we've got a few minutes for a couple more questions. Stephen asks, is AVAX used as a utility coin to pay for compute storage like gas and Ethereum? So is there anything that will remove transaction cost volatility? Gun, I think you sort of answered this in part, which is that the AVAX token is necessary to secure the network, but maybe not necessary in these private marketplaces to execute transactions. Maybe that needs some more unpacking. So if you can, maybe just talk about that for a sec.
Well, I think, the question is really asking about fee volatility.
Yeah.
And there are lots of different ways that fees are managed in different chains. The predominant one that everybody's familiar with is people submit bids in their fees. They attach fees to every transaction, and then the network accepts them. And the miners accept these transactions and choose to include them in blocks. So what does Avalanche do that's different? Number one, having very, very high scale already goes a long ways towards making fees lower. Why? Because we can clear thousands of transactions per second, and that speed gives us, that allows us to clear like a far more volume than anyone else. That tends to lower the fee pressure. The second thing is fee management in Avalanche is different from everybody else. The fees are set on an epoch basis. Everybody within the epoch has to pay the same fee, and the fees do not accrue to a given miner. They're burned, and so they benefit everybody. So this means that we do not have the kinds of pressures for ratcheting fees up that you see in chains where the fees are going to the miner who mined the block, and the fees are chosen through a first auction. So we have a very different mechanism that is essentially saying like, well, given how fast the blockchain has been growing, what should the fees be for the next, so many seconds? And so that allows us to move the fees equally for every participant. And it's an ongoing experiment, of course, but we're going to see how this impacts the fee selection mechanism. The theoretical results all show that this is a far better way of managing fees than to have everybody compete with each other in a ratcheting game of one-upsmanship that then leads to sky-high fee results.
That's great. We have a couple more minutes left. Maybe just a sort of big picture for the folks who are listening in on this. Okay, so you've described Avalanche and Avalabs and why people in financial markets and in the enterprise should be looking into this. You mentioned the ease of use. Where can someone go today to begin to experiment and to tinker away with this while your testnet is live? And then what steps should they take if they want to get in touch with you if and when the mainnet goes live and they're ready to really start going to work? What are some of the things that they can do?
So there are a couple of places to start from. So first of all, avalabs.org is a great starting point. You will find the documentation to the entire system there. You'll find pointers to everything you might need, the downloads and so forth, the SDK, the developer kit and so forth that one might need to start. You will also find pointers to documents at different levels of technical depth, describing the protocol in detail, providing proofs of gruesome math detail, all the way to high-level token economics. The avax.network site is a great place for exploring different other things about the protocol, such as the wallet. You can get access to the wallet from avax.network. In fact, it's very simple. It's wallet.avax.network. And we have a faucet that allows people to collect some testnet tokens right now, and people can just experiment with this. And quick finality is something to be seen. Most people are not really used to issuing transactions and having them complete before they can blink an eye. But they are final and immutable in the blink of an eye, in about a few hundred milliseconds at the moment in our current testnet. We're aiming for about a second or so of finality. So those are starting points. If they want to get in touch with us, I'm very visible online. They can Google my name. On Twitter, I am Elite Haxor, EL33TH4X0R. But if they want to contact us, the best way to do that is contact@avalabs.org, and we'll be reading the messages and we'll be responding to everybody who sends us things.
That's great. For everyone who's listening in, if you go to the chat, you'll see that I've included some of these links: avalabs.org, avax.network, and contact@avalabs.org. This has been a really interesting discussion. I'd like to thank John and Gun for joining us today. Just looked at the clock and we're already at the top of the hour. I feel like we could go easily for another hour, perhaps longer. If you're interested in understanding a bit more about how blockchain is going to change and transform the financial services industry and asset classes, I would strongly encourage you to please check out the Blockchain Research Institute website and to also check out our courses on the Coursera platform in partnership with INSEAD. Yulia, our partner here, has already shared those links. I'll ask her to just please do that again so everyone can access that. And with that, another heartfelt thanks to John and Gun, and I will hand it over to the executive chairman of the Blockchain Research Institute, the co-author of Blockchain Revolution, Don Tapscott, to provide some closing remarks. Go for it, Don. You're on mute.
Thanks so much, Alex. It's a little breezy here, so I hope you can all hear me okay. John and Gum, that was a terrific session. And I just wanted to end with a little advertisement from our sponsors. At the BRI, we're now publishing a series of books. And the book Supply Chain Revolution has come out, and just got a great review this morning in Cointelegraph. And these other two books, Platform and C-suite revolutions will be coming out in the months ahead. The supply chain book came out as the number one hot new release on Amazon in the commerce category. So that was kind of cool. But I wanted to end with a book that's very relevant to the session that we're having today. And it's The Financial Services Revolution. It's edited with a major essay by Alex Tapscott, and it's available on Amazon right now. This, in my view, is the most profound book written, not just about blockchain and the financial services industry, but about the financial services industry itself, at least the contemporary industry and how it's evolving. And if you buy the book and read the book and you don't agree with me, I want you to ping me at the Blockchain Research Institute, and I will send you a check or a bit of Bitcoin or something, a bit of something to pay you back. I'm kind of confident that I'm not going to have to do that at all, because this is a gorgeous book, and I encourage you very strongly to pick it up, to have a read, and to let us know what you think. So, Alex, back to you to close things off.
Well, that's great. I appreciate when somebody pumps my tires like that. It's a good feeling. So do check out the book. Do check out some of these other resources. And please let this be the first step on your journey in learning more about Avalanche and Avalabs. This is a really critical moment in the sort of arc of history, especially as it relates to financial markets. We are seeing the wholesale reinvention of whole asset classes. And for the first time in maybe many centuries, we actually have a new medium for value. And it's projects like that Avalanche and Avalabs that are helping to create the conditions for that transformation to occur. So this is really the exciting moment that I think many of us have been waiting for. And we encourage you to get started. You know, leadership is everyone's personal opportunity, whether you're in an enterprise or you're a financial market participant. If you're interested in investing in protocols, all of these different perspectives can be applied to the current subject and to Avalanche. So thanks again for joining us. And thanks again to John and Gun for a really terrific session. We hope to see everyone soon. Take care.
Thank you.
Thank you.